Welcome back. Well, let's get straight to the management of Kalyan Jewellers. It's the first corporate that we have on the show. And the company clocked in, pretty good set of numbers, 20% revenue growth versus last year. But they say that high competitive intensity, that's what led to lower gross margins for the past quarter. Key positive, though, is that Kalyan Jewellers came out with a strong update for the festive season as well, with around 25% growth. To understand more about the outlook from here on, we're joined by Mr. Ramesh Kalyanaraman, the Executive Director at the company. Hi, Ramesh. Morning. Congratulations on a pretty good showing. I want to ask you a couple of points out here. One is, what was your studded share, in quarter two? If you could give us a sense out there. Where do you see that number headed? And also your market share. You've been talking about increasing it, right? What was it and where is it headed?
Yeah, so first of all, Q2 has been good. We are extremely happy with the outcome. Studded ratio is improving year on year and quarter on quarter. If you look at a consolidated studded ratio, it would be in the range of 23%. If you are talking about India business, the studded ratio is 26% in Q2. And this is also a function of the stores which we have in the non-South region. We have been expanding outside South India, and all the new showrooms which we opened this financial year is also outside South India. And of course, there is a natural shift to the studded segment as well. So our focus will be to increase the studded ratio in the coming quarters as well as in the future years.
Okay. There is a big boom that we're seeing in weddings in India, right? And a big chunk of your earnings comes from there. I mean, I was just reading a report which said that there are 32 lakh weddings in India within the last 41 days. I'm sure you're making the most of that. So just tell us, how does this reflect on your own earnings, say for the full year as well as for FY24?
So as we have updated, the Diwali minus 30 days revenue, which we have recorded is approximately 25%, which itself comes from a very high base of Q3 last year. Q3 was fantastic last year as well, right? And we would have absorbed some of this wedding demand in the Diwali festive itself.
Okay.
But yes, November, December again is very, very crucial for the wedding segment. Our team is geared up. The inventory is also focused on the wedding segment products. The campaigns are also focused to that. And but of course, we should not keep 25% revenue growth as a benchmark for Q3, because Q3 we are already starting with a very high base. But we believe that it will be a good double-digit growth. And as a brand, our wedding segment revenue is usually in the range of 55%. So the target revenue is also wedding focused, and we believe that Q3 will be ended.
So when you say double-digit growth, you've done in the first half, I think, revenues of a little over 6,800 crores overall. Is that a level that you can maintain? Can you do better than that in the second half?
So usually Q3 is a bit more heavier than Q1 in terms of revenue. So that's all I can tell you.
Okay, but it's interesting. Ramesh, hi, good morning. You're saying that some of this huge wedding-related demand could have already happened, right, in the quarter that you've reported numbers for, but Q3 will be better. You'd indicated this pilot franchise stores. I think you'd opened one in, I believe, Aurangabad, and the last time you'd said that you'd open 5 more before Diwali. What's the progress there, and what are sales looking like here?
So as we speak, we have already opened 5 franchisee stores in India, and we are extremely happy with the outcome. The revenue momentum there, the operation module there, and it's almost set now. And we have now signed 6 more LOIs for franchise in India. We have also signed up the first LOI for Middle East operations franchise, and we are extremely bullish on the franchisee momentum which we are getting across. We are already in talks with 50 odd franchisee partners, prospective franchisee partners, and our expansion will be majorly driven by the capital efficient franchisee module, and that's the franchisee update.
So, Ramesh, is this like one large player, or each store is a different franchisee? I mean,
each store is now different franchisee.
Okay. Is that hard to manage? Is that hard to manage, or not really?
No, but we have a ecosystem which can nothing to manage as well, because meaning it's only updates which we have to give to them, etc. Because it's a FOCO model. The store is managed by us.
Okay.
Ramesh, you've mentioned that competitive intensity, that's what's hurt gross margins. Is that easing a little bit? And also, what's the outlook on margins for the second half of this year?
So gross margins, actually, we improved by around 0.2% when you compare with the previous year-on-year, quarter-on-quarter also. Quarter-on-quarter, there's a dip, but it's not actually comparable between quarters.
Right,
gross
but
margin.
Ramesh, the reason I ask you this is because you have mentioned there was some competitive intensity. So give us further details out, yeah? Is that easing gradually, and the margin outlook? Go ahead.
No, competitive intensity is very high, but our studded ratio increase, etc., we are able to negate the gross margin impact substantially, right? And if you're talking about the EBITDA margins, if you look at Q2 last year, actually the advertisement expenses started from a very low base because we were just coming from the Q1 impact of lockdown. And this quarter, we have a one-time provision done. And if you negate both of them, the EBITDA margins would have been in the range of 8.1 to 8.2. And that is the way to look at it.
With 8.1, 8.2 from here on?
That's I will not be able to give a guidance, but that is the actual figure if you negate the one-time provision which we have done and the ad expenses which was not there in Q2 last year, and we had to do this year. We had to start the campaigns also earlier in Q2 because Diwali was early this year, so we had to start the campaigns by September second week.
Little unfair, the provision I take it, but higher ad cost, we cannot exclude that. That will have to be taken into your operating margins, Mr. Ramesh. Final question, what's the debt in the books? Is there a reduction plan out there?
So again, just to clarify on the advertisement, we had to start our campaigns a bit more earlier this year because Diwali was early this year. Okay. So it is not an actual Q2 impact on the advertisement. It is actually a Diwali campaign which was preponed because of the Diwali which is coming earlier this quarter. And regarding, you were asking about the debt. Yes, we have a reduction in gross debt by around 100 crore and gross debt around 50 crore and the net debt around 100 crore. But we have now a debt reduction plan as well for the next 3 years because as a brand now, as I told you, the franchisee arm is almost stabilized and we are having very good traction on the franchisee momentum. Our expansion will be now majorly driven by franchisee, which will bring in a lot of free cash in the books for the next 3 years. We will be targeting to reduce our debts, which is majorly the cash credit, which we'll be reducing because that comes with a higher interest cost.
Okay, so double-digit growth by end of FY23. You're looking at double-digit market share as well?
So market share, again, that it depends upon how much you are present across the country. But as a brand, we always try to become the number 1, number 2, number 3 player in the micro markets where we are. And the SSG has also been strong. It has been in the range of 7% in Q2.
All right, fair enough. Ramesh, we'll leave it there. Thank you very much. Good luck. Appreciate your time here on CNBC-TV18. As always, we'll take a break here. We'll, of course, heading to the pre-open, which is 4 minutes away. We'll also have Nilesh Shah of Envision Capital for some market chat. It's an important day, and how's Nilesh watching things from here for markets? That conversation on the other side.